Unemployment, bankruptcy, homelessness, a global economic crisis. Should we be optimistic or pessimistic about our global economic recovery? Exploring the impact and seeking solutions, United Nations University presents UNU Conversation Series, The Economic Crisis.
Welcome to this edition of the UNU Conversation Series on the Economic Crisis, organized in connection with the June 2009 UN Conference on the World Financial and Economic Crisis and its impact on development. I am Jean-Marc Coicaud from the United Nations University. And with us here today we have Thomas Hoenig, who is President and Chief Executive Officer of the Federal Reserve Bank of Kansas City. So, Mr. Hoenig, thank you for being here.
I'm delighted to be here today.
Thank you. And so, Mr. Hoenig is with us here today to speak about systemic risk and the concept of too big to fail. And you have been very outspoken about this notion in relation with the current financial and economic crisis. So perhaps, Mr. Hoenig, let's begin with this notion of too big to fail. What does it mean, and why have you been so adamant? You have been a strong voice on the topic.
Well, too big to fail is not a new concept, but it has been expanded, and it is where we come to the conclusion that an institution that may be in financial difficulty or clearly close to insolvency should be, in a sense, bailed out using the public funds. And we say that because of the concern that if it does fail, the repercussions to the broader economy would be so severe that it would be more harmful. My concern is that when you do that, you change the criteria from other than objective set of criteria that you normally have when you have institutions that go into bankruptcy or taken over by the Federal Deposit Insurance Corporation in the United States, to where it becomes in a political process, one that says you will save you we won't, because we're absent that. And therefore it becomes inequitable, and the outcomes themselves can be inequitable in terms of their impact. So it's not that I don't agree that they need to be resolved, but they need to be resolved systematically under the same set of standards each time, and then you will get, I think, the same good outcomes for the economy and less disparate outcomes to other parties in the economy. And so that's why I'm.
So, but the question is, why is it that we let this happen?
Well, I think it starts back more than a decade ago when we did change the rules. We used to have the separation of banking and investment banking, for example. We wanted to deregulate the industry, and so what we decided to do was allow them to merge, allow them to carry on the same kinds of activities regardless of their history, so that they could become ever larger. And I even wrote at that time that it gave me some pause because these institutions would become increasingly large, and if they did get into trouble, which they inevitably would, that they would be so large that we would be reluctant to deal with them as we do other bankruptcies. And therefore, the impact of the economy would be ever more devastating should they fail. So it happened because our goal was to deregulate the industry, and we didn't think through all the consequences as well as we might have, and therefore we are at this point.
But so is it an East Coast phenomenon, and is it something which is indicative of the close relationship existing between certain banks and Washington?
I think it's not so much an East Coast phenomenon, but a size phenomenon. You have institutions that are so large, and they are, by their size and their ability to control resources, politically powerful. And therefore, whether they were on the West Coast or the East Coast or the South or the North, their size and political clout gives them a more favored position when it comes to dealing with the difficulties that they find themselves in. And so I think that's wrong.
But I mean, for these banks, for these institutions to become so big, required initially political access, because something had to be done to let this happen, right?
Well, they had the access by under the sensible proposal as it was presented of deregulating the industry so it could be more competitive on a global basis. So the effects were not thought through. In other words, yes, we'll deregulate, but the ability to then grow was based on the fact that antitrust laws are not in a position to limit their growth.
Yes.
There were no strong regulatory limits, such as leverage ratios, that contained their growth, and therefore they became ever larger and therefore ever more powerful from an economic point of view.
And as an official from the Federal Reserve Bank, why is it that it is so much of a concern for you, this notion of too big to fail? Why is it, you made it your mission to talk against it?
Well, because an economy that is to be successful over a long period of time has to be efficient and has to be competitive. And if you have institutions that are themselves mismanaged and get into difficulty where they would fail, and you save them, the economy doesn't have that ability to renew itself. And it doesn't keep it competitive and sharp and focused. It becomes favored. And when something is favored, it tends to, whether it's a family or a business, it tends to become less efficient, and therefore it actually hurts us in the long run as an economic force in the globe.
And you also use the notion of I mean, the word equitable.
Yes.
So how do you dovetail or connect your concerns for efficiency and your concerns for having an equitable system?
Well, when I say equitable, I mean equity of treatment and equity of outcomes. If you take a bank in our region, for example, in the Midwest, and it's a large regional bank, has impact on that region. It's held to a standard of performance. It's held to rules of how they conduct themselves. And if they fail to comply with those rules, and if they get themselves in trouble, they are allowed to fail. Now, they may be taken over by the insurance corporation, and they may be sold to another party, or they may be liquidated, but they pay the consequences of their mistake. When you have a system where they are too big to be thought to be able to go through that process, then you get unequitable outcomes. They become a favored group. And I think that is very detrimental to any economic system.
And you feel that it is something that we have been witnessing in the past months, a double standard treatment when it comes to banks which are too big to fail, and when it comes to other banks which are just regular banks?
Yes, I do. For example, when the so-called Troubled Asset Relief Program, the TARP, the $800 billion, there were 9 banks called in and said, you will take this. The other 7,000 banks, if they wanted it, had to apply and had to meet standards and had to go through a process and were rejected. That's clearly not the same treatment for the same kind of entity, and therefore is objectionable.
And precisely, I mean, what have been the consequences of this state of affairs for regular banks? I mean, I was in Puerto Rico a few months ago, and I was told that by bankers that in fact, all this money is going to these big banks, and in fact, while regular banks are in need of credit, are in need of liquidity, well, they don't have access to this money.
Right. Well, and the effect is that if you know an entity, if you're a business and you're going to put your money somewhere, and you know there's this group of banks that won't be allowed to fail, therefore you won't lose your money.
Yes.
And you have all these other banks that could fail, and that you could be subject to losing your funds. Where are you going to put your money? You're going to put them in the large bank, and that gives them a competitive advantage. And that is, I think, wrong under the principles of capitalism.
Yes, and you have seen this happening in the past months.
Well, in the past months, actually in the past years, because while many people from the last 2 decades argued that there wasn't such a thing as too big to fail, I argued that there was, and that when we did some research, when you looked at some of the literature, you found that there was a premium that went to the largest banks.
Yes.
If they could get over, at one time the number was over $100 billion, their ability to raise funds was less challenging. They could get it at lower cost. Another example is when you have the government-sponsored enterprises like Fannie Mae and Freddie Mac in the United States, they could raise funds at favorable terms, even though they supposedly weren't insured. But everyone knew that if they got into trouble, they would be bailed out, and therefore they were willing to give them a better deal. And in fact, when they got into trouble, they were bailed out.
Yeah.
And so that it proved itself correct. And therefore, all that does is entrench the concept of too big to fail in our economic system. And I think that's harmful to any economic system, including the United States.
Yeah. And precisely, what have been the consequences of this double standard treatment for the real economy? In your region, for instance. What have been the concrete consequences of these double standard policies?
Well, it's in the sense hard to see in terms of an obvious effect, but you see it in little ways. For example, if you can raise funds in the largest institutions at less cost than the regional or smaller, then you can lend funds at a better rate, gain market share, gain power, and therefore slowly but persistently you will become a dominant part of the market. And when you look at the last 20 years of the resources controlled by the 10 largest institutions in this country from where they were 20 years ago, it has almost doubled.
So it has eroded the network of medium-sized or small-sized banks in America.
Right. There are, number one, they have less control of the total assets available. Therefore, they are involved less importantly in the lending and in the intermediation process than they were 20 years ago. I think local communities feel the effect of that in little ways and then over time in more important ways in terms of credit. Now, the largest institutions will say, well, we have networks that go into the communities, but let's face it, there is a different orientation for these largest firms than there are for the community firm.
Absolutely.
And the community feels the effects of that. And if it were on a level playing field, if they both had the same and they had to base that advantage on their service, their willingness to be competitive, their willingness to serve the community, well, that's one thing. But when it's because they have an advantage from a cost point of view, that's an entirely different thing, and it undermines our market system.
And all this based on favored treatment and not the product of institutional efficiency, if you will.
It's an implied subsidy to the largest institutions, and the subsidies, of course, always give you an
and
advantage.
it hurts the vibrancy of the economic life of local communities.
Over time, it does. Yes.
So let's imagine that we think that in the end these banks are not too big to fail. Let's have them failing. So what would it mean, and what would be the impact of have these banks failing?
Well, let's understand now, we have allowed them to get this large.
Yes.
So the impact of their failing would be significant.
Yes.
Whether it would be dramatically more or less, we won't know until something is allowed to fail. Lehman Brothers, that did go into bankruptcy, is often given as an example, but over the long term, I'm not sure that the Lehman Brothers failure will not show itself to be a favorable outcome. Only time will tell. So but the fact of the matter is, if the largest institutions fail, it would be devastating.
It's a bit too late now.
Well, no, not necessarily. It's how you then approach it.
Yes.
For example, if you had a large institution fail and you have a mandatory resolution process, so you will have the FDIC or the Treasury, some party, take control of that institution. You can then put new management in at the very senior levels. You can break out what's called a bad bank, the assets that need to be liquidated, and you can do it in a systematic fashion. You protect the franchise value. It'll be a smaller institution, but you can protect that through the government guarantees for that institution while it is in transition. So the economy can continue to move, and you get through the problem more quickly, and when it's all done, you have a smaller institution that is more vibrant, and I think in the long run, you have an economy that will be more vibrant. So it's not that you don't do it, it's that you do it in a systematic fashion that gives you the right outcomes in the long run. Just propping them up, turning things around, it is not improving the economy for the long run.
Yeah, in fact, this is what you recommend in a lecture that you delivered in Omaha, Nebraska in March a few months ago. But I mean, so it hasn't happened.
Right.
Do you think that it is still an option? Do you think that it is something which is on the table? And do you think that it would be a good thing for this to happen?
I think it is still an option. I think it is on the table. We now have a Treasury proposal That does include the resolution process. I think of that as a starting point. It needs to be strengthened significantly, and that it needs to say, if you have an institution that is difficulty, there is mandatory intervention. That is, if it's insolvent for either a capital insolvency or a liquidity insolvency, that is, it can't make its payments, then it is taken over. It puts new management in. You don't have to remove all the infrastructure. Then you have the assets examined, and you put them aside as the bad assets. And you liquidate those over time, and then you protect that franchise. That can be done today.
Yes.
That can be done on a prospective basis. Now, the largest institutions would resist that, of course,
Yes,
because
of
they
course,
would
yes.
subject them to the market's discipline.
Yes.
And, of course, they would lose their favored status, and I think that would be good for America.
But isn't it paradoxical that the biggest institutions are also the ones which seems to be to go against the philosophy of the market, the philosophy of capitalism?
Well, that's normal.
That's
In time,
normal.
whenever you have an institution that has a vested interest, I don't care if it's a government, I don't care if it's a financial institution, once it gets its position, it wants to protect that position at all costs. And therefore, the market and its discipline becomes less meaningful to you, although you still believe in it for someone else.
Okay, yes.
It's like taxes. I'll increase anyone's taxes but my own.
Everybody has duties except me, who only have rights and
That's right.
entitlements.
That's exactly right. And of course, that doesn't work.
Yes. And precisely, so you have been one of the strongest voices on the matter. How has it been received? That's why we wanted to speak with you, because you have been very vocal, very forceful. How has it been received? First of all, within the banking community, and also perhaps in Washington.
Well, it's been received within the banking community among the large majority of banks. Been received very well, from the regional banks to the community banks in America. I would say probably among the largest banks,
Yes.
less well received.
Yes.
I've not talked with them directly. In the political framework, it has also been received well. I think they're concerned about whether you can implement it in reality, but I think you can, and I think we need to continue to discuss and demonstrate that it can be done. And I think then it will be received within the political framework, and we can develop a law, a resolution process that is mandatory, that is clear, has objective rules of procedure under the rule of law, so that then you have equitable outcomes, not equal outcomes, but equitable outcomes. And then the economy will be well served in the long run.
And within the Federal Reserve Bank community, how has it been perceived? How has it been received? I mean, do you have a plurality of voices, or are the people of one voice?
I think there is a plurality of voices. I think there is, it's been well received within the Federal Reserve. Most people do want to see an enhanced resolution process. Where the differences come is with the perceived need for exceptions. And that's where I have problems, because once you open up the exceptions, you open up it to politics and to disparate treatment and to disparate outcomes. That's what you want to avoid. I'm firmly in the view that, no, if you have a clear rule of law, a clear set of procedures for approaching it, and that you do not waver from that, you will be able to implement it, and it will have good long-run outcomes, and that you can even manage the short-term disruptions better than doing it ad hoc, case by case, change from one to the other, create uncertainty around that. This would avoid that, and I think is a preferable.
But so far, the philosophy of exceptionalism, if you will, is winning the day.
Well, it has, because of when you're working with a crisis, you tend not to be the one who said no and risk the situation getting worse. That's why the rule of law is so important, where it takes it out of my hands, out of that political, well, what are people going to think? If you can clearly say, this is how we've agreed that it will be handled as a community, as a nation, then you can say, this, I'm following that, I believe in it, and we will have good outcomes. But you have to think that through in advance, not in the middle of the crisis when it's ad hoc and you're and you're unable to make those hard calls.
So at the core of your concern is precisely the importance of the rule of law and moving away from an ad hoc approach which in fact allows having an unhealthy relationship building up between the political sector and the financial sector.
That's exactly what I'm saying. Mm-hmm. The rule of law, thought through in advance, carefully.
Yes.
I mean, we have to think of the consequences, there's no question about it. But having thought it through, then that gives you guidance.
Mm-hmm.
Because otherwise, ad hoc means different treatment.
Yes.
And it means who has influence
Mm-hmm.
and who doesn't. Who knows the secretary of X or Y
Mm-hmm.
and who doesn't. Those are very bad outcomes for an economy and a society.
Yeah, so your voice, your concerns are very much about economic rationality, but also economic justice.
Absolutely.
And justice altogether as connected with rule of law.
I don't think, I think that's, yes, the answer is yes, because I don't think you can have a system that runs long unless people have confidence in it,
Mm-hmm.
and even perhaps faith in it.
Yes.
That they will be treated the same under the law regardless of who they are.
Mm-hmm.
And that's important.
No, it's essential, that's key.
It's essential.
So precisely turning to the way forward, so how do you see things unfolding in the coming months or years?
Well, I think there will be an extensive debate. I think it's begun. The white paper that the Treasury put out is what I call the starting point. I hope that there will be lots of testimony on this by lots of experts, others, some that you've called, to make the point that let's proceed with this. Let's make this. Let's focus on the rule of law and a reasonable procedure for the treatment of all institutions, regardless of size. Get through that debate. Come to the conclusion that yes, we do need to set that out, and I think the next time we have a crisis, and we will,
Yeah.
I think it will be handled in a systematic way, with consequences falling as they should. You know, the one thing you have to acknowledge in this is that cycles occur. Economies go through recessions. If you do everything you can to avoid that, you can in fact jeopardize the very institutions that you're trying to save and the very economy. No one wants to have people out of work. I certainly don't. But sometimes you can put more people out of work trying to save,
Yes.
trying to avoid the adjustment than you can by facing up to the adjustment and getting through it under a prescribed approach that people see as just and see as working over time.
So your voice has been a very important one at the national level. What are the implications of your thinking, of your approach at the global level in terms of what would be the rule of law in international finance?
Well, I think because you are involved in a global economy and you do have relationships worldwide. In fact, I've been told that the United States can't do this on its own. The rest of the world, they're going to outpace us as far as the competitive position goes. I don't accept that. I think, number one, we can do it on our own because if you don't have faith in your own economic system, I don't think you're going to convince very many other people. And I think because we are, as a country, a very important, if not the dominant, a very important economy, I think others will be required to approach it in a similar manner.
In essence, you set the tone.
You set the tone, you lead.
Yeah, and if you precisely put forward this message of ad hocism or exceptionalism,
Right.
I don't think that you are setting the right tone.
That's right. I agree with you completely. And a country that is in a position of leadership should lead,
Yes.
should set the example. And that's what the United States can and should do.
Yes, in the end, it's not what is at stake. It's not simply rule of law in the U.S., but the ability of the U.S. to somehow convey and project the idea that rule of law is something to abide by at the global level.
One way to think of it is that we are working under the rule of law successfully. I don't think that we can have an international global economy that doesn't have the same principles.
Yes, absolutely.
So you have to migrate to this principle, and we will. And to avoid it, because you're afraid they're not going to, is to self-destruct as far as an economic system.
And in a way, because of the position of leadership in which the U.S. is, there is a sense of accountability which is not simply national, but also which is international.
Right. It is international, and we can set that tone. And I think other countries to be successful, they know that they have to have the same principles in place.
And they are watching.
Yes.
They are watching what is being done in the US. They are certainly watching.
Right. Of course they are, and taking our lead to some degree.
Mm-hmm.
Now, I'm not naive. I think they will, in some instances, try and avoid that because of their own political needs or circumstances. This is not something that takes and changes overnight. It is a process that moves through time, but I think it has a better chance of moving through time successfully if we abide by our own principles. Yeah. And that, I think, is critical.
So in essence, you are telling us that it's not simply the credibility and the legitimacy of the system which is at stake within, but it's also the reputational value of the system at the global level which is at stake in all these issues that we are pushing forward.
Well, let me give you an example. I think since World War II, the world's economies have grown tremendously. And I think the United States led the way because it opened its borders to trade. It led the movement towards greater free trade or open trade. The world prospered because of that. We didn't come afterwards protect our borders, protect ourselves. We led. We made this gesture. We opened it up, and I think the world benefit. So it is with the issues around our largest financial institutions. We can make a difference if we choose to.
Mr. Hoenig, I really thank you for your time.
Thank you for this opportunity to speak to you.
No, it's a pleasure, and it's important. What you are saying is very important. That's why we wanted to speak with you. Mr. Hoenig is President and Chief Executive Officer of the Federal Reserve Bank of Kansas City, and he was kind enough to spend time with us talking about precisely the concept of too big to fail and what is at stake, both at home and abroad, in connection with this concept. Thank you for watching. I am Jean-Marc Coicaud from the United Nations University, and we hope to see you next time. Thank you. Thank you, sir.
Thank you.
I mean, this is